Good morning. How you doing? This is Ernie with 0 days to expiration, and this is the morning analysis. This is going to be actually a new feature. Now I'm broadcasting this publicly right now, but it's going to be mostly a private affair or internal to the 0 DTE service. But I wanted to explain a little bit about what we're doing here. So the market just opened. I plan on doing this at the market open. Now, we normally don't take any trades or anything at the market open. We wait for volatility to sort of settle out and figure out what's happening in the market. But this is meant to go over the analysis for the morning, figure out what energies are coming into the market. And of course, as the market opens, things can change dramatically. We expect some economic reports. Here, let me put these on so I can hear myself. Oh, that's beautiful. There we go. So there should be some pretty strong economic reports coming out. Well, there will be pretty strong economic reports coming out in just a few minutes that will have a potentially large impact on the market. And the other thing that I think is pretty impactful today is the fact that it's before a long holiday weekend. Yet another long holiday weekend. It seems like every other weekend is a holiday weekend these days. But given the current economic climate and the elevated volatility, and then having a long weekend, time typically equates to more volatility. And that's because the longer the time is that you have to anticipate something happening, the greater the uncertainty. The greater the uncertainty, the higher the volatility. And it's basically because there's a greater chance that something can happen. And it's one of the reasons why we like 0 DTE, because we can squeeze time, or we can choose a time range that's very small. And I guess theoretically, we have more control over, or we're able to anticipate where price and volatility and things are going to happen, so that we can make more informed decisions and potentially get a better trade-off or higher quality trade. Doesn't mean that it's always there or it's always worth doing, but at least you do that. And because it's the 0 DTE, or the very last day of expiration, we have a number of things that are converging right on that end-of-day event that put an edge on our side. So we have smaller compressed time. We have premium that is decaying at its most rapid rate until it gets down to 0. And we typically have a little bit of volatility right at that on that last day, and particularly right at the very last few moments. And all of those things can work in our favor if you do the right thing. Now, one of the, let's see, we have some people online. How you doing? There's Gloria, there's Dan, Jeffrey, I haven't seen you for a while, and will do, and I'm sure others will pop on. So let's start by going over the morning analysis. Normally what I do is I look at the market structure and try to come up with some scenarios where I believe things are going. So let me just go over what our general process is for taking a trade, and also going through and managing a trade. Generally what we're doing, or the very first thing that we're doing, is we're doing a market structural analysis using volume profile. So we want to get a feel for where the market finds value, where it doesn't find value, and we indicate that through looking at the volume nodes, and then the lack of volume nodes, what is called the low volume node, or the lack of volume node, the LVN we call it, because those areas, the node itself, its edges, the top and bottom edge, and the low point, are generally pointing out inflection points, or where institutions and other traders are lining up with orders to protect those features, or those nodes, those levels of value, or the levels of no value. Why they all decide on those areas, that's a big mystery. You know, why do it's just, I have no idea. But it doesn't matter. The question isn't why, it's just that it's there. And the interesting thing is that these volume nodes, now most people that are using volume profile are looking at session volume, or they're looking at the most recent volume that is happening, or the volume of that day. And the problem with that is that it's not really looking at the big picture or why price is actually behaving the way it is. Price behaves the way it is because of where people have lined up their orders, right? And if they're not there, then you can't expect anything significant to happen there. So looking at a session may be interesting for what's happening then and there, but it's not going to tell you that there is a point of resistance here or support here. It's just not going to say that because it can't. It may react to support and resistance that had been generated, a long time ago, and people are lined up there, but the session volume isn't going to indicate that. The most you're going to get from a session volume profile is the shape of that might indicate a trending day or a consolidating day or a balanced day or whatever you want to call it. But that doesn't tell you what's going to happen in the future. It tells you what happened, and you don't get that shape until the day's over. So what good is it? Some people might look at the point of control of the previous day as if that has some magical power, and it doesn't unless it lines up with where traders are and where their orders are now sitting. And generally they're sitting at the edge of very big or old or historical volume nodes. So that's why we look at volume profile. We look at the big picture, take in as much as a year and a half worth of data, find out where those prominent nodes are, where their edges, where their low parts are, because all of those are significant. And then we apply our behavioral analysis too, because there is a certain way that price behaves.
Returning visitor.
There's a certain way that price behaves as it goes through these nodes. So I'm going to turn that. Oh, it is off. I wonder why that's going nuts. Let's put that way over there. So we apply a behavioral analysis once we have an understanding of where the energy is in the market and it's traversing across this kind of landscape or structure, market structure. You hear that term all the time, market structure. But what the hell is a market structure? To a lot of people, a market structure is a bunch of trend lines that they draw up. To us, it's not that at all. It's the actual place where people are sitting with orders. That is the real structure, because that's really the only thing that is affecting whether price moves through an area with resistance or no resistance, right? And generally, when you look at a volume profile, you think about the way that a market behaves as it's traversing. Markets do basically two things, maybe three, right? So markets are either trending or they're consolidating. And some people might say, oh, they're reversing too or whatever. But that's neither here nor there. It's just another consolidation in a different fractal, right? So markets are either moving fast through an area or they're moving back and forth through an area. And that is usually dictated by what the forces are behind it, that can push it, and what is the resistance. It's like a physics problem. If there's no resistance, if there's no liquidity, if there are no people there sitting with orders trying to defend a level, then it's going to give an opportunity for some bigger players to move price either up or down until they find where the next level of value is. Right? I guess you can call that price discovery. It's finding that next level of value. Once it finds it, and there's some stickiness there, which is usually happening at a volume node, then they start, churning over it and trying to discover exactly where that value is. And, they never really find exactly the value, but it's moving back and forth. So it trends and then it consolidates. That's what a market does. And it does it in every time frame, big and small, that same behavior. You can call that a sort of a fractal anomaly, right? It's not even, well, it's not an anomaly. It's a fractal fact that we trend and consolidate in virtually every time frame. So within a very large trend that may last over days, right, or months or whatever, even inside there's trending and consolidating, trending and consolidating, trending and consolidating over something like that. And even within one of those little features, there's trending and consolidating. Kind of like a Mandelbrot set, no matter, how deep you go. Of course, the limiting factor is the amount of time that we have. So that's generally how markets work or behave, right? And so we use the volume profile to try to figure out where it's likely to trend, where it's likely to consolidate, and what those levels are. And then once we understand that, and once we understand the potential behavior, we can create scenarios. And those scenarios are really important for us because they first lay out a plan. Where are we going to put our trade? Where are we likely to see price go? And where is it likely to stall or find resistance or support? What points is it likely to approach? And when it does approach, if it goes through that, is it going to then start accelerating its move to another area of value? So in other words, if it comes into an area of low liquidity, we can see that, and we can make the assumption then if it approaches there, either it's going to come through and move all the way through very quickly, or it's going to get rejected and come back. So these are all behavioral elements that we know, and so we watch them, and we plot them, and then from there, we can then model a trade. And that trade is largely based on the things that we know. With options, for instance, we can model these things knowing three separate pieces of information. Like I said, we're looking at price movement, and you can equate that to delta, right? So price is moving. Then the other thing is the amount of volatility that's actually in the market. That kind of looks at the range that price is moving, or its basically its range. That volatility translates directly into whether you have inflated or deflated premium, the amount of premium, and that will a lot of times tell you whether or not you can put on a strategy that has one characteristic or one risk to reward, a favorable one or an unfavorable one. And then the third element, so there's price movement or delta, volatility, and those things are variable. The third is time. Time is not variable. Well, it goes to a certain very definitive point, right? So when time in the sense of the session is going to end. And what's going to happen at that end. That premium is decaying. But while it's decaying, it is sort of undulating back and forth based on what the volatility is doing. So those are the three things that you know. And you can use strategies that can take advantage of all of those things or isolate any one of those things. The one thing that we're trying to isolate is the decay of premium, and be more on the seller's side of that decay so that we can collect the premium. So that's what we're doing. We are analyzing the market, figuring out what the potential behavior is, looking at scenarios that we believe could happen. Of course, when the market starts up, if those scenarios don't necessarily get followed, then you have to kind of reevaluate what you thought. But you get better and better at it over time to come up with some solid scenarios. You always come up with at least two scenarios, a bullish and a bearish case, and maybe some other case, maybe two bullish cases, one bearish case, so that when the market starts off and starts, flailing all over the place in the beginning of its session, and that volatility gets shaken out, it just finally decides on a direction, and then you can tell whether or not it's actually following one of your scenarios, and now you have a good predictive model. It may not be perfect, but it's probably better than just guessing, in the beginning. And then you can develop a model or an option strategy that will take advantage of the things that we know, like the end of day. So that's basically what we do. Let's see. Do we have any questions here? Do you specifically look at for trapped traders, whereas the idea of previous support turns into resistance? I don't use any of these kind of terms, trapped traders or, bull traps or bear traps or anything. That's superfluous stuff. That I suppose it has meaning to people, and I understand what they're trying to say, and they're trying to communicate various ideas. But quite frankly, all I care about is where there's liquidity, where there isn't liquidity. Is price moving through that area with force or no force or little force or not? Right? Whether you want to characterize them as trapped or free, it really doesn't matter. Right? All that really matters is where you think price is going to go, creating some kind of plan, and then developing a model to model that plan, and then executing that plan. Now, the other thing that we do is in the execution, we want to give ourselves the best opportunity for profiting. We want to also give us the best possible risk to reward. We know that through simple math and also from experience about the way people kind of make it in this life, that taking very, very tiny risks for huge potential gain is absolutely the best way to go, right? So we try to emulate that. We try to create asymmetric trades, asymmetric positions that have very, very tiny risk with huge potential gain. That way, we are not really ever sweating the risk side of the equation. Where most traders, that's all they do. Everything that most retail traders are doing is sweating the risk management. I like to say it's not really risk management, it's loser management. They're managing how much they're going to lose. And that creates a kind of a psychological impairment to a trader, that they're constantly trying to worry about that. That's everything that they're focused on instead of how much they're going to make. So we turn that whole thing around and say, well, okay, let's define what our risk is so that we don't have to worry about it. We accept it. We accept it right up from the beginning. We're not sitting here trying to create high probability trades for tiny, tiny little potential profit and then worry about risk the rest of the time. We flip that. And we look at tiny little risk that we can shuffle away and now just worry about that spectrum of profits that's in front of us, and put ourselves in the best possible position to collect that. All right, let's see. We have another question. What is the fraction of time the market consolidates and trends? Well, it's a fractal. So in other words, there's all fraction of times, from small to large. It depends on what time frame that you decide to trade in, right? We're trading within a very, very narrow slice of time that is the very last day of expiration. And we even are experimenting, as you've probably seen with our final hour trade, on the very final hour of expiration. So that's a special case that we're looking at that is kind of a fractal of our larger case, which is looking at the whole day, right? There's some value in putting on a trade early in that you can collect a little bit more premium, but it's not that much more than waiting until that final hour, believe it or not. There's still a lot of premium left there. The difference is that you have a slightly more deterministic view of where price is going to go in that final hour as compared to, say, putting on a trade at 9:30 at the beginning of the market open, or even before the market opens. So you're taking on extra unknowable conditions for a little bit more premium. But you have to decide, is that amount of premium and the risk to reward type of scenario that you can model, is it worth it? So we don't know that. We have some ideas, and we have different ways of looking at it. So from a zero DTE perspective, we can look at the entire session. And that's how we first started that off with futures when we first started the service back about a year and a half ago. We looked at futures as the way to go because we could get ahead of that last day because we had more premium. We could literally put on a trade right after economic reports were generally released around 8:30 in the morning and get ahead and sometimes get enough premium and a good enough risk to reward strategy that we could collect enough by, say, noontime or 1 o'clock to get out of the trade and be happy. Every once in a while, because we're able to put it on that early and get a wide enough spread in our strategy, we could hold it because price looked like it was going to hit the short strikes that we had put on and hold it as long as we possibly can until we get close to expiration and maximize that profit. So that's one way of doing it. And I felt like that was a really great way of doing it. The problem is that most traders are scared away by two things. And the reason for they're scared of these two things is this is baggage that they have from their retail trading experience. And that is that in order to do that type of strategy, you need to use futures. All right? So futures have some idiosyncrasies that maybe make them a little less attractive to the uninitiated trader. The one that wants, to take away all the problems that they can't deal with, like commissions or assignment, right? Now, first of all, the assignment really isn't a problem because you can't get assigned until the market has closed, until it's fully expired. So what's the solution to that? Don't hold into expiration, right? These are European-style options, so you never have to worry about it. The other thing is that futures generally have much higher commissions than, say, the SPX, options on equities or options on the SPX. And if you look at it, soup to nuts, it's probably about 6 times as much commission and cost. However, if we're putting on asymmetric trades and we're looking at going after very large returns, then that should outsize and dwarf the commissions to a point where it's not really that big of a deal. It's sort of like the difference between paying 2 to 5% for the futures against your average return that you're getting, or paying, 0.5%. 0.5% between that and 5% is really not that big of a deal when you're looking at, collecting a much larger potential payload, right? But still, it's very difficult to convince people that are used to going after tiny little profits and then having to deal with what appears to be very large commissions relative to the profit that they're going after. And so it takes a while to kind of knock that into their head, but some people cannot let go of it. No matter what you do, you can't convince them. So for the past half year, just to sort of placate a lot of the traders that we've been taking on in our service, and look, I don't mix words here. I'm completely honest. We have, switched mainly to trading the SPX because it's cash settled, so you don't have to worry about expiration, and so you don't have to exhibit the discipline it takes to actually get out before it expires. And so we take that weight off their mind, which is imaginary. And so now they don't have to worry about that, and it's cash settled, and they can just let it go, and they don't, they can be willy-nilly. They can forget the discipline that they actually need. And it costs a little bit less, right? So now they can feel like, they're getting ahead of the game, or maybe their account is so small that they can't manage it. Last year, I started with a $3,000 account. I traded exclusively the E-mini S&P futures. Very costly. Every trade that we put on had a 30 to 36 cent tax to it. Right? So I had to make more than 36 cents before I even made $1. And I took that $3,000 account in 9 months to $9,000. Just trading this strategy, exhibiting that kind of discipline. Right? So it can be done. The hard part is convincing people that they can shed their minds of all of these perceived problems and say they're not problems if you look at what we're actually trying to do. So given all that, I guess what I'm telling you is that I'm going to probably go back to trading futures again. And if that's a problem, then you'll probably have to leave the service. Right? But there's another advantage of trading the futures, especially for people with small accounts. And it's sort of a dichotomy, right? Sure, it costs more, but with futures, you don't have any pattern day trader rule. None. You never have to worry about putting on a trade. And now, especially now that we're going 5 days a week instead of 3, the pattern day trader rule says if you're in an equity position, which the SPX, whether you're trading the SPX or trading it with options or the SPY or anything, you have 3 chances to, within a 5-day rolling period, to do a day trade. After that, if you do it again, your broker's going to tag you and potentially close down your account for 90 days. So now, people want to come up, well, are there ways around this, Ernie? Maybe I can open multiple accounts. Or maybe I can come up with some way that I can zero out or hedge my position and let it fall into expiration. All of these things are workarounds that cause you to spend extra effort and brain power that you don't need to spend. It would be much easier, just to deal with the extra cost and the expiration problem, which isn't a problem, with futures. You could trade 1,000 times in a day, and you never have to worry about the pattern day trader rule, ever. It's liberating. You can trade outside the market. Again, liberating. Now, of course, trading futures and plus, trading the futures is a smaller contract. It's about 1/3 the size as the SPX. Granted, it doesn't have the same level of liquidity as the SPX, but it's still not bad. Yes, the futures contract itself is one of the widest traded assets in the world. It has plenty of liquidity. Not as much as the SPX options and not as much as SPY options, which is, huge, but it's still so big you never have to worry about it. As a matter of fact, it's so big that no matter how big your account is, even if you have an 8-figure account and you're trading 100 contracts at a time, it's still going to be able to absorb everything that you put at it. So the liquidity problems that people mention or the difference between them are not really problems. They're imaginary problems. Let's see here. More questions. What is the okay, we talked about that. What is the fraction of the time? We said everything's fractal. You mentioned seller premium earlier. Can you talk more about profiting off of premium? Yeah, sure. I mean, everything that we do at Zero DTE is about collecting premium and taking advantage of the exponential decay of premium going into expiration. So at no other time in an options contract's life is it decaying premium, or if you're the net seller or putting on a premium collection, there's no other time where you're collecting premium faster than on Zero DTE, the last day of expiration. And it gets faster and faster and faster as the day wears on. And it's amazing how much premium is available at the beginning of the day compared to 12 o'clock, compared to 1 o'clock, 2 o'clock, 3 o'clock, and then the waning minutes. You would be surprised that there's not much difference between the beginning of the day and 1 o'clock. There is difference, for sure. But the difference between 1 o'clock and 3 o'clock is huge. So in other words, the rate that it decays is huge. However, that extra time and that extra premium also gives you the advantage, particularly if you're playing with the changes in volatility, and you can time it right. In other words, you can buy the rumor and sell the news, so to speak. These premium collection strategies they are what you call vega negative. What that means is that they perform better when volatility is declining. And when I say do better, that means that you can collect premium faster as volatility is declining. Conversely, you can get a better risk to reward if you put on a strategy as volatility is rising. And the more it rises, and if you can catch it right at its peak, that's the best time to put on a strategy, because you're going to get the best risk to reward and the best amount of premium that you can then carry into expiration. That's super important for a number of reasons. One is that you can get that good risk to reward, right? So you can put on a trade, instead of putting on a trade that is 1 part risk to 5 parts reward, maybe you can put on a trade that's 1 part risk to 12 parts reward, or 1 part risk to 15 parts reward, and still have the same kind of probability of profit, because you don't have to move further away to get that kind of risk because of that volatility, change in volatility. That's a huge advantage, because now you can also create wider spreads and cover a much wider range of prices. So that's another big advantage. So you can increase not only the amount of potential profit you can get, but you can increase your probability of touch. Those are the advantages of trading with futures. You start getting limited when you start trading into the day and trading with the SPX, the bigger index. It's harder to create a wider spread because it starts getting expensive. That's the other problem. It's bigger. You could, I guess, go for the micro, and that will alleviate that somewhat, but not really. So again, I'm making the case why we really should be going back to futures. Going back to the future. It's a smarter way to trade. It's easier, even though it's more expensive. And then there's this imaginary risk of assignment. It gives you more to play with, more meat on the bone. So anyways, that's my my take. I wanted to, just get that off my chest. That's probably a direction that we're going to be going in. Oh, it's definitely a direction we're going to be going in the service. We'll still do the SPX, and we'll even look at SPY, but SPY doesn't trade 5 days a week. The futures and the SPX both trade 5 days a week. And there's some issues with that as well. Trading 5 days a week isn't all it's cracked up to be. The trading on Monday, Wednesday, and Friday is not equivalent to the trading on Tuesdays and Thursdays, which are the new days that they've added. The trading on Tuesdays and Thursdays has a different character to it. There's less liquidity. I don't think that all of the institutions have really embraced it fully, and what that really means is that they haven't programmed all of their algos to figure out how to take advantage of it yet. And as they are doing that and coming up with these new algos and new ways to take advantage of it, that poses problems or difficulties that we don't really, see directly, but they translate into just trading is a little bit harder to analyze and come up at the end of the day with some level of consistency from day to day. So, although I think eventually Tuesdays and Thursdays are going to be just fine, right now, it's a little squirrely. Not bad, but it's just something that I've noticed. Besides, I like trading Monday, Wednesday, and Friday and having Tuesdays and Thursdays off. That's a big relief. When we have holiday weekends like this weekend, it used to be that if Monday was a holiday or Friday was a holiday, they would push the 0 DTE day to the previous or to the next day, depending on, respectively. Friday moves to Thursday and Monday moves to Tuesday. So these days, we're just going to have, one less 0 DTE because we're trading 5 days a week now, which is no big deal. What is a big deal is the fact that we have elevated volatility in the market. And the reason why we have that elevated volatility is that everyone is in a panic over inflation and where the market is going. It's not doing well. The next thing to fall, obviously, is going to be jobs. And when that starts falling, people are going to be running around like chickens with their heads cut off. It's going to happen. There's nothing stopping it. And so things are going to get worse. Now we're heading into, that's the context behind going into a long weekend, a holiday weekend. Everyone wants to forget about the market. But when you have an extra day where nothing is happening, that means that there's more uncertainty. More things can happen. Anything can happen, whether it's overseas or whatever. Our analysis in the morning includes a geopolitical and economic analysis. That's what we do besides the structural analysis of market profiles so that we can figure out these energies that are coming into the market. When you have 3 days instead of 2, that's 50% more crap that can happen. That's significant in the world of options trading. Now, the advantage of trading futures is that even if there is a holiday, the future's still open on Sunday night. So if you're in a position and something crappy happens, right, you can get out of that position. Or you can put on a position on Sunday night and then close it on Monday morning. That's the interesting thing, that when you have a holiday like that, and it's a Monday holiday, typically what happens, and a lot of people don't realize this, that the equity markets might be closed, but the future markets are still open. They just alter their schedule a little bit. It's usually, they open up on Sunday always, and then they close at either 11 or 1 o'clock, depending on the type of holiday it is. And then they reopen for the next session, which is actually the Tuesday session, but it reopens on Monday at 6 p.m. Eastern Time. So there, with futures, is another advantage on long weekends where you think that you are at a disadvantage, that you want to contract and not do anything. Futures, you can be, act like it's just another day. Another plus for futures. Let's see here. So LZV saying, to clarify, whether you're trading futures or SPX, the strategy is the same. Pretty much. There's some differences, idiosyncrasies, right? And when you say the strategy, let's be very clear about what we do here. We don't have the strategy. We have strategies, we have methods, and we have process. What we're teaching here is a system for traders that come into here to learn the system, to take the tenets of that system, and they can copy, exactly what I do if they want to, and build on that. But ultimately, traders here are creating their own version of 0 DTE based on the tools, the methods, the strategies that we put together, the techniques, the process, the continuous improvement process, where they find their own way. And it may perfectly parrot what I'm doing, that's fine, but that's not the intent. The intent is to make everybody an individual trader here. So when you say the strategy, there is no the strategy. There's my strategy, which may or may not be the best one. I don't know. I can tell you for a fact that under certain conditions, many conditions, there are traders that are within our service that are much better traders than I am. Maybe they're not as good of an analyst, or maybe they are. I don't know. But, they have developed their own system. There are several traders that have been with us now for over a year that have definitely developed their own take on how to approach the market, and they do fantastic. So there is no the system. There is no just trading SPX or futures. You can still trade both. You can trade one or the other. You can do whatever you want, right? But I think by following the advantages that we lay out, regardless of the nature of your version of the system, it's still going to have those edges that we've identified. All right? Hopefully that makes sense. What are options traditionally or originally used for? I'm not sure exactly what difference that makes, but I mean, you can look at the historical context of options trading. It goes back, I don't know, since the beginning of time, since people have been developing contracts. You know, it's just a way of managing something with terms and with counterparties. I mean, futures are kind of like options, but they differ in that they don't have that time value. They have time, and they are based on time, but they don't have a variable time value. And they were designed originally to help mostly agricultural concerns to manage their profits from the time that they grow or harvest a crop to the time that they bring it to market, so that they can hedge against the volatility that might occur that might cause them to lose value in their crop. And then the same thing for the buyer, right? That's originally what it meant to hedge, and it still does. Anybody that's involved in commodities trading uses futures and options to hedge their positions in their crop or their commodity to even out the time between where they acquire or create or, find this commodity, dig it out of the ground, and the time that they actually process it and then bring it to market. That's what hedging is actually for. It's not to hedge your position. People don't even know what they're saying when they say, hedge my position. Let's see. I prefer the futures. Don't have to convert futures to SPX strike. I have messed this up before in my trading. Okay, there's a very good point. Another advantage of futures. The SPX is not a real thing. You cannot trade the SPX. It's a calculated index. Therefore, it has no volume. There are no people actually trading the SPX. So therefore, you cannot do any analysis or, worthwhile analysis on the SPX because there's no volume. And volume is everything. Unfortunately, that's a lost art with most retail traders. Well, it actually was never introduced for a very specific reason. New visitor. But most retail traders look at volume as sort of a secondary indicator or a confirmation of their price when they have it exactly wrong. Price is a consequence of the volume, not the other way around. But that's kind of hidden from most traders, mostly due to the broker narrative that you've heard me talk about. The broker narrative essentially is this, that they want you to trade like most retail traders do, often, and trade by all means, trade by all of the normal distribution and statistical analysis and everything else that's in your trading platform. Just keep on trading, because all they really care about is that you create transactions. They know that most of you are going to fail because you're not looking at volume, you're not looking at the actual problem, you're not looking at real supply and demand. You're looking at made-up things with lines and crap and other tools that are always lagging. And they're fine with that. And then they throw at you sell-side analysts that are there specifically to get you excited about trading on something. And these analysts have no experience in the market. They have the things that they analyze. They have no actual experience in the thing that they analyze. But that's perfect because they can get out there and they can, basically influence billions of dollars and billions of transactions, all for the benefit of the broker. But anyways, that's what the broker's there for, to get you to trade. Trade the tasty trade way, right? The law of large numbers. You can dial in your profit and your probability and return on capital. Just trade lots. Basically what Tasty Trade is saying, do it that way so that you can join our Tasty Works network and create transactions. They're not an anomaly. They're not like alone. This is how all brokers work. So I got off on a tangent there. I was explaining that there is no volume in SPX, but there is volume in the futures. So we do all our analysis on the futures, and then to placate, you keep on using that word, placate all the people who don't want to mess with the futures because it's so scary. We have to do the analysis on futures, and then we have to translate it to the SPX. So there's another level of indirection, and another reason why the SPX is not the ideal way to trade zero DTE or trade anything. So good point, Alan. What you think of a trader by the name of, I don't give a shit about any other trader, period, end of story. Really don't. I don't think about any. You want to know what I think about that person? I don't think about that person. End of story. I don't. I really don't care. All I care about is what we're doing and our methodologies and our process. We are process obsessed to do what we're doing because it has edge and because it has mathematical certainty that in the long run, we have a positive expectancy. We're trading the same way that all successful people operate in the world, taking small little risks, and we can take lots of them. It won't hurt us. We can keep on trying, looking for those outsized profits. That's what we do. The problem of wash trading. Why are all these things problems? What is the problem? Just get in there and trade and keep track of what you do, and that's what you make. Period. If you don't have enough money, then trade within your means. You don't have to worry about these problems if you trade within your means. If you trade small, you never have to worry about them. It's only when you overextend yourself that you have to worry about these problems. It's the only time you have to worry about them. So don't do it. Trade small all the time. Take tiny, tiny risks. Put yourself in the best possible position. Be smart about what you do. And you'll never have to worry about wash trades or assignment or managing your risk. A lot of the the psychological issues that come with trading will basically get swept away. Doesn't mean that they're not there. They're still there. They're just not as big, and you can concentrate on other things. Keep a clear mind and make better decisions by trading small. And if you think you've chosen something small, right? I can guarantee you could probably go 1/5 that size, and it still won't be small enough. All right, here's another great question. Well, the assumption that the market is manipulated and there is no supply and demand, there is, but the thing is, it is because the market is manipulated that there is supply and demand. The market is always manipulated by everybody. And yes, there are bigger concerns that have a stronger hand, and then there are others that do, but there's so many of them. They're all trying to manipulate it to their best advantage. If you had billions of dollars, I guarantee that you would be trying to manipulate the market to your advantage. See, the difference is that when you have big money and you're manipulating, there's only so much of that you can hide before you show your hand and what you're doing. And so you're like a big ship on the ocean. You cannot, move with any kind of agility. When you're a small retail trader, you have that agility. And if you know how they're playing the game, you can trade on their edges. You can trade off of their surf and make a lot of money relative to them or relative to anybody else, but maybe not relative to them. But you can make a lot of money by playing those edges and just understanding what they're doing.
Returning visitor.
I mean, when analyzing volume, how do you get around the wash trading? Fake volume. There's nothing fake. Just go by what the charts are showing you. You're not big enough to worry about that, is my point. Right? You're just not big enough to worry about it. If you're trading $1 billion hedge fund, then yes, you have to worry about it. But you have access to the dark pools. You know what's out there. You don't have to worry about it. So stop worrying about it and stop pretending that it's actually a problem. It's not. All right. Let's see. I think we have a question that's outside of this in our Discord. I am removing SPX from my charts as you speak. Yeah, I agree. So there are a lot of people within our service that are, asking when's the most opportune time to get into a trade? When should I take profits? And these are not hard problems, but they are problems that we iterate over and get better and better at over time. There is no one answer, I can tell you when it's easier to get in and get out. It's a lot easier when you have a better risk to reward. In other words, if you can separate and expound on this idea of small risk, large reward, then getting in and getting out become far easier. And the reason for that is that, first of all, you have much more range of prices to work with, and therefore you have more time, because when you have more range, it takes more time to traverse that range. You also have a greater spectrum of various profits that you can get in and out, because now you have more profit. So given a defined period of time with more profit, there's more time for that profit to rise. It's going to be rising faster, in other words. So there's going to be more of it, and it's going to be a wider range. The other thing is that when you concentrate on that asymmetry and you have wider spreads that you're working with, and you get down near the end of the day and you're wondering, man, I've only got, a 5 wide or a 10 wide spread, and I'm really trying to, time it to get the maximum profit. It's hard because you only have a 10 wide spread. But if you had a 25 wide spread, it would be 10 times easier. The problem is that when we're using the SPX, we don't have that option. We have to trade narrower because of the cost and those limitations. But if you had a much wider spread, then the gamma risk is how pointy your profit curve is, right? And as you move left to right on it, how fast you fall off those edges. That gamma risk increases with narrow spreads. It decreases with wide spreads, or it's more tolerable with wide spreads. So if you want to know, what's the answer? Well, the answer is, if you want to play in that world of narrow spreads, because that's the way you're trying to reduce your cost, then you have to come up with strategies for grabbing those profits when they're there, right? Instead of chasing them. Because chasing them is hard. But that's also another strategy. You can get really good at staging trades, canceling and replacing, seeing what your gamma risk is, planning on where you could place acceptable degradation in the potential trade that you had, just so that you can get in or out, you can play that game. And it's a valid way to play. As a matter of fact, that's been, I think, the biggest thing that I've been trying to help people with, because they want to trade with the SPX, the bigger index, and have narrower spreads and all that stuff. And so we're trying to come up with better ways to do that. But it's so much easier if you had a wider spread. Way easier. So again, I'm sitting here like convincing myself of what I should have been doing all along, and not listening to people about using the SPX. And I know that one of my students here agrees with this, because they're mostly a futures trader anyways. Then they don't have to make that that mind shift. But yeah. So anyways, I got off what was the main topic here, and that was just to do an analysis and so forth. But I guess this was really more of a sort of an introduction to the morning analysis. It will take on a number of things. I think generally we'll have a structure to these in the future. We will go over the morning analysis, which is the structural analysis and the geo-macroeconomic condition, also the political condition, because that impacts. Figure out what the vector of the market is. In other words, what is its direction and its magnitude of direction. We will look at the scenarios that implies once you marry that vector with the structural, right? And then using our behavioral constructs. And once we have that map of scenarios, that plan, we can then start coming up with strategies on how we can take advantage of those scenarios with very wide, as wide as possible, asymmetric trades that will collect premium sometime during that day. So that's what the morning will be. Setting that up, coming up with then the staged ideas that will model our analysis. Okay? So that's what we do. If you want to join the service, go to 0-dte.com/try. Do a 4-week trial. You'll love it. Okay, Dr. Russell has a question. Ernie, can you go over why you can do wider spreads on ES compared to SPX? The commission seems really... Were you listening to anything that I said? I don't care about the commission. The commission is bullshit. The bigger commission is total bullshit. If you're stuck in that mindset, the reason why you can get wider spreads is because you can actually put the trade on earlier, and you can get a better risk to reward. And when you can get a better risk to reward, you can make them wider, and you can actually make them closer to price or your projected price. The big thing is getting the risk to reward. If you can get tiny risk to big reward and as wide as possible, you're going to be putting yourself into a better position. With the ES, the margin size will also be smaller overall. So you'll get even a better price. And, so for instance, if the difference is between having to accept, a $100 risk as opposed to a $40 risk, I'd rather take the $40 risk, because then I can make my things, even wider and give myself a better chance of profiting. And getting over that 36 cents isn't as hard. See, what I'm trying to say is that I did this last year to prove a point that you could take a small account with high commissions and make it work. Sure, in the beginning you have a lot of account volatility, equity volatility, but that's natural when you have a small account, because the size of your positions and risk compared to the size of your account is not a huge disparity. But once you start building and getting, going from say 3,000 to 5,000 to 10,000, now the size of your account relative to the risk that you're taking on starts diminishing. right? And then when you get a little bit bigger, you get out of that, that disparity, that volatility. Your equity curve starts smoothing out, and your drawdowns relative to the size of your capital become smaller and smaller. If you can already start at like 10 or 15,000, you never really even experience this. But it is a consequence of having a very small account, and that perception that the commissions are very large. But when you have a larger account, you can trade the wider and have more breadth and room for making mistakes and making choices, and you don't have to be as quick on your feet with making those choices. I'm not saying that that is a good thing. I'm saying that it provides a little bit more latitude and makes it a little bit easier for you to grow as a trader and develop your strategy and your process.
Returning visitor.
And this is true. The better price with ES should easily make up for the trading fee cost. It does. It just does. Right? I never understood when people first brought this to me. They said, "Oh, the commission's so high, Ernie, I can't take it." And I think, I've never even noticed, because the amount of profit that I'm going after dwarfs the commission cost. Usually I'm going for a 5 or or 8 or 10 or $15 reward, and they're worried about 30 cents. I'm like, why? So the problem is I'm worried about the difference between, say, 36 cents and 6 cents. I'm not. Not if I'm going after $5, $10, $15, $20. I don't care. Especially if that thing that cost me a little bit more is giving me much greater opportunity. The problem is convincing people of this. So even when, last year it was easy. I actually did it and people saw it. And, everyone was just coming in, "Oh, this is awesome. This is awesome."
Returning visitor.
And then we get more people in that weren't as familiar with futures and had this stigma. And I've said this before, that the number one obstacle that I have with new traders is reprogramming their minds to get out of this mentality of the broker narrative. Everything that you've ever been taught about trading is absolutely wrong. Everything. It is the exact opposite the way professionals trade. And that is a tough thing to convince people of, because, it's ingrained in them. But, I'm telling you all of this because I was involved in the industry. I've run hedge funds. I've supported all the institutions. I didn't just support them. I ran an organization that actually built all their systems and implemented their strategies. So anyways, okay, so here's a question. But we still do day trading. Yeah, I mean, if you're taking a trade with futures, the day in a future starts the day before at 6 p.m. in the evening. We used to take trades at 9:30, 10 at night. It's still a day. It's still that session for the 0 DTE. And a lot of those trades were damn successful. Super great risk to reward. So now you have the option of trading anywhere from 6 p.m. the previous day all the way up to a few minutes before it expires. You have an 22-hour window now, where with SPX you only have a 5-hour window. What would you rather have? A 5-hour window that costs you more, or a 22-hour window that costs you a lot less? And when I'm saying a lot less, I'm saying the potential risk relative to the actual commission. It's like a no-brainer. But I capitulated to all these people that just couldn't get it through their head. But hopefully, now I will. And if they're listening to this, buckle up, because this is the way we're going. You can still trade the SPX if you want, but I'm telling you, futures are the way to go. I've been wanting to say this for such a long time. Anyways, while we were talking, you wouldn't believe what the market's doing. Let's see. Yeah, see, the market opened up right here, right there. It went way up here and then way down here. Isn't that wonderful? The market has no idea where it wants to go right now. Well, it does, really. Ultimately, it knows that it needs to go down. It can't help but go down. But it's going to go kicking and screaming until it gets down there, all the way. And we're going to continue having bear market rallies with huge drops. We just got over a bear market rally. That one's come and gone, and now it's time for the next drop. Right? So there was our bear market rally. A very short 2-day consolidation, followed by the realization that inflation is here and it's not going away, and then a deterioration into some wild swings, and now more downside to come. I suppose it's possible we have another rally, if Uncle Jerome gets out there and says something magnificent, because he's been so right all this time, right? That the mainstream media and Wall Street are lapdogs to him, and they'll listen to anything that he says, anything that Uncle Jerome does. He is our man. And also the politicians, because he's not political. I say with great sarcasm. But we are going down for that next leg. It'll look just like the last time we went down after a bull market rally. I'll show you what that looks like. So, so here was the last bull market rally we had back in May and into the beginning of June, and then we had a 10-day consolidation. Oh, by the way, remember I talked about trending consolidation? Well, there's your trend with the lack of volume, and then consolidating, building a node with lots of volume. Now we're breaking down, going down, trying to find the next level of value. Just happens to be right here now. We start consolidating a little bit more. We break down some more. And then we do another bull market rally, a very short period of consolidation, breaking down. Again, we break down through the volume wells because there's no liquidity there, or very little. And then we find another place where there is liquidity, and we hang out there because there's gravitas in that liquidity. And then we're going to break down into volume well 2, and eventually down below T0, and then we're going to fall again into the great abyss. Back to the big head. When it says, good, no more SPX, 0 HTE trades. No, we'll still do those. That's an experiment that we're going on, and now we can do it with futures too. We'll see how that works out. Right? So we're still going to do that. That's an experiment. It's an experimental trade that I'm committed to do 100 instances of, so that we can gather enough information to see whether or not it should be part of the, the bag of strategies that we have. So we're still doing that, and doing that out in front of everybody, so it's completely transparent, what we're doing. So people see, that's how we operate
Returning
here.
visitor.
This entire service is directed by the members. We have a continuous improvement process that we institute
New
every
visitor.
week. Every week we have a retrospective meeting where we discuss our trades, the strategy, what we did right, what we did wrong, and what we can, if we should change anything, and then move it on. And we've basically done that since day one. And it has benefited, although we did go off on a wrong direction, I think, and now we have to pull it back. And that is what we've been talking about today. Focusing more on the SPX instead of what really is the superior asset to trade. Lance has something else to say. Doesn't the Fed chair have English PhDs working for him that review his speech in case he uses words that spook the market? Yes, of course they do. They script everything. But, then he has the Q&A, and it all comes down to how well he's been coached to try to not veer off the narrative. Because that is the primary tool of the Fed, not interest rate manipulation, although that is the end result. Their primary tool are words and convincing people that they're going to do something. Seriously, that's it. But you're right. It's not just PhDs, but they also have AI working on this as well. Trust me on that one. Alan says, The Great Abyss is really scary. Why? Oh, the movie is. That's a great movie, by the way. The Abyss. Probably see my net worth cut in half. Be interesting to see if my gold silver holdings hold their value and hedge my equity holdings. They're probably not, because most investors are convinced that the Fed is going to solve inflation. That's why gold relative to the value of money has actually gone up. I mean, think about it. Gold has held its value while the dollar has been rising. And so gold, now then if you compare it to other currencies, gold has actually gone way up. So, in fact, gold has been holding its value, just in a sort of stealth kind of way. So, I don't know. What do you want to do? Go all cash? Just trade the 0 DTE and nip away at the edges and, stay ahead of the S&P? I don't know if gold is ever going to explode, right? I mean, that is, maybe eventually, but first we need to crash this market. We need to get down to fair value or actual value, whether it's fair or not. Need to burst all those bubbles. And there's lots of them that need bursting. Housing market's probably bursting now, or at least correcting. I don't know if the housing market can burst anymore with all the controls that they've put on it. But anyways, I think I've gone on too long, and hopefully this has been useful to people. The wife's feeding the birds outside. And I hope everybody has a great holiday weekend. 4th of July! Ah! Gonna party hardy. Spend some time on the beach house, campfires on the beach, that sort of thing. Well, Alan, if you taught them well, it won't matter if they get laid off. It'll be a little bit of pain, but I'm sure they'll figure it out. All right. Let's see. I need to close these things. There it goes. Again, thank you very much. We're going to get busy on today and see if we can conjure up a trade. There will be a final hour trade, as always. Yes, I know. Everyone has a 4th of July, but not the same 4th of July we have. But the market's still closed, so the futures market will be interrupted slightly, so it's still there, and we will still be here. We will have our normal Sunday evening meeting, our retrospective, after the futures market opens, and we might even take a trade, our first futures trade in a long time on Sunday evening. Imagine that. We're going to get back to the old way of doing things and then take everything that we learned on top of that and then just keep on improving this service. All right. Now, thanks, will do. Hope you have a great holiday too and celebrate our independence, what little we have left. But thank you all very much. Peace to you all. We will be doing the next retrospective on Tuesday morning, and that will be the first of, regular what this should actually be. It's not going to be this long diatribe like I did today, but it's going to be direct and to the point and setting ourselves up for the trading day. Take care. Peace.